All right, guys. I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got Carley Garner, and she's talking about options trading. And what I asked Carley to do was kind of put together some basic information for this first webinar, and then I intend to ask her back, and we'll get more advanced as we go. So the first webinar is going to focus on just the absolute basics. It's aimed at new options traders, and we're going to cover as much information as we can on how to get started with options. And then we'll go into more complex discussions and techniques in later webinars. As you guys have questions for Carley, you can type them into the questions box, and we'll do our best to get everyone's questions answered today. Now, I've got a little bit of a challenge on my side today. I've got some noise in the background that I hope doesn't pose too big of a problem to the webinar. But before I turn things over to Carley, I wanted to ask the room to give me an idea of who's here today. How many people are brand new at options trading versus how many people are already currently trading options? Would you just type that into the room real quick? And I see some questions about the webinar itself. So yeah, the webinars are always recorded. I'll post the recording on BMT sometime tomorrow. I also will send a link to Carley, and she can send it out to her followers. All right, so the overwhelming number of people in the room are brand new to options. So that's perfect. That's exactly who we're targeting for this webinar. All right, awesome. Okay, guys, and also at the end of the webinar, we're going to give away 5 autographed copies of Carley's book, A Trader's First Book on Commodities. Has really good ratings on Amazon. She's written several books, but we thought that would be the best one to give away for this webinar. So pay close attention to the content in the webinar, because the 5 quiz questions at the end to win a book are going to be based on what was covered today. Okay, guys, give me 1 second, and I will be turning things over to Carley. Hang on.
Okay, can everybody hear me?
Yeah, I can hear you, and we see your screen. And Carley, before you get started, I had a couple questions for you.
Beautiful.
First of all, do you want to hold questions to the end, or do you want them to come in as they go? How do you want to handle questions?
I usually will try to answer them as I go, if possible. So I'll just kind of keep the little box open, and if I see them come through, I'll do my best. If I miss any, by all means, we'll try to make sure they get all get all taken care of at the end.
And I also wanted to congratulate you on your appearance yesterday on CNBC's Mad Money. Jim was really in love with your crude oil analysis. He went on and on about it, didn't he?
Yeah, it was fun. It was a good time. Jim can make anything interesting, right? I mean, you give him something and he makes it exciting. So
very, very passionate about it. Yeah.
Yeah, he really is. He's a good guy.
So if anybody missed that, I posted the link on the CNBC video. It's on the thread here. I'll send it out to the room real quick. Okay, thanks, Carley.
Are we good? Okay. Let's see here. Okay. All right. First of all, I'm sorry for the delay there. I just had to get situated. I want to first and foremost thank Big Mike for inviting us. He definitely puts on a great service. I haven't had a chance to really dig into the forum yet, but from what I've seen, I'm impressed, and I appreciate him giving us the chance to come and present. And obviously, he's doing it's a great service to the trading community to provide educational venues such as this, because we all know how difficult trading can be. And it's really important that people fully understand the risks, the rewards, and what exactly they're doing when they're putting their money on the line. Okay, I know all of you know this, but it's my job to remind you that there's a substantial risk of loss in trading futures and options. And it says financial loss, but you know what, there's a risk of lots of things in futures and options. Your sanity, your dignity, all of those things are included. And you know it's risky when you see there's actually a risk disclosure on the risk disclosure slide. So there you go. And there's even more risk disclosure. obviously you're not going to have time to read this, and you probably don't want to, but the idea is, we're going to talk about a few minor trading examples. This is a beginner class, so we're not going to get into details, but you just want to keep in mind, whether you're listening to my webinar or somebody else's webinar, just because we put something on a screen and say, hey, look how much money you could have made or could have lost, it doesn't mean that we know what's going to happen tomorrow, and we're gurus and all those types of things. So just do your own homework, make sure you know what you're getting into, make educated decisions when you're trading. Here's my contact information. If you decide that at the end of the presentation you forgot to ask a question, or you just wanted to get a little more information, or whatever the case is, please feel free to contact us. If you visit our webpage, we have a lot of educational material. It's free. There's articles, there's videos, and of course we're on Facebook and Twitter, so we'd like to see you there. Just real briefly, I want to introduce myself so you know who I am and what I do. I am a broker at Carley Trading. We're a brokerage firm. Just want to put that out in the open so that everybody knows. I'm also a market strategist. I write a couple of newsletters for our clients, the Carley Perspective and the Financial Futures Report. And I've also written a couple of books, actually 3 books, and I'm an author, well, I should say a columnist for Stocks and Commodities magazine, so you may have run across my name there. The 3 books I've written are Commodity Options, Currency Trading in the Futures and Forex Markets, and a Trader's First Book on Commodities. It's the 3rd one today that we're going to give away autographed copies for, because this is a beginner's class and that's a beginner's book. It seemed to be most appropriate. All right, let's dive in. What are options? Well, an option is a financial derivative written against a specific underlying commodity futures contract, or it might be written on a stock, or maybe it's even written on a Forex contract. But it's a derivative, and in the case of options on futures, it's a derivative on a derivative, so it gets a little bit crazy. An option represents an agreement that offers the buyer of the option the right, but not the obligation, to buy or sell a futures contract at an agreed upon price up to an agreed upon date. And I know that's a lot to say in a sentence, so we'll kind of break it down for you. There's basically 2 types of options. There's a call option and there's a put option. A call option gives the buyer the right to buy the underlying futures, Forex, or even stock at the stated strike price. So for example, if we think crude oil is going to $100 a barrel, we might decide to buy a $100 crude call option. I'm not saying you should do that. This is an example. In fact, I probably would very rarely recommend anyone buy options, especially in crude, because they're really expensive. We'll talk about that later. But for example purposes, if you think crude's going higher, in fact you think it's going above $100, you might buy a $100 crude call option, and that option would give you the right to buy crude at $100. So if we're trading at 90 right now, that option, it's worth a little bit because maybe crude will go up in the future, but you wouldn't want to buy crude at 100 if you can buy it in the market at 90, right? So it's kind of a lottery ticket is a way to look at it. But if for whatever reason crude oil rallies sharply, and let's say crude rallies to 105, all of a sudden having the ability to buy crude oil at 100 when the market price is 105, that's pretty attractive, right? So that's the idea of what an option is. It gives you the right but not the obligation to buy at the stated strike price. Now a put option would be the opposite. If you think crude's going to $80, you might buy a put option, an $80 put option, and if crude drops to 75, it would be really nice to be able to sell it at 80, so your option would be attractive at that point, probably worth a lot more than what you paid for it, because buying a put gives you the right to sell the underlying futures at the strike price. Now a lot of people get confused over the price of the option and the strike price, but it's pretty simple. The strike price is just the price where the option kicks in, where it becomes valid. The premium or the option price is how much you're paying for it or how much you're selling it for. It's the price of the option. And this is everything that I basically just explained to you, it can all be said with pictures, right? A picture says 1,000 words. Well, this makes things a little bit easier. A call option, if you buy it, it's bullish. If you buy a put option, it's bearish. Now, keep in mind, you know how everyone always tells you trading is a zero-sum game, right? If you buy something, someone else sells it to you, one person's going to make money and one person's going to lose money. It's the same whether you're trading futures or Forex or even stocks, even though you don't really look at stocks that way. That's really how it works. Somebody's giving up their shares for you to buy them, and so if the shares go up, you're making money, but whoever sold them to you is probably sorry they did. Options are the same way. If you buy a call option and the value goes up, the person that sold the call option is wishing they wouldn't have sold it to you. They were on the other side of your trade, and you're winning and they're losing. It's always going to be that way. Whoever buys the call is going to have the opposite payout as the person that sells the call, and it's the same on the put side. Now, the one thing that is really key here is when you're buying options, you have unlimited profit potential and limited risk, which on the surface sounds fabulous. I mean, who wouldn't want limited risk and unlimited profit potential? That just sounds great. But what we're going to learn in this class is it's not necessarily as great as it's cracked up, or as good as it's cracked up to be, at least not always. Because the odds of success in buying an outright call or an outright put aren't necessarily always attractive. So you have to be selective in when you're buying options and when you're selling options, and a lot of traders actually do a combination of both. And we're going to very vaguely talk about those sorts of things, but in the next webinar we'll start to get into the strategies in which you would put option combinations together and sell options and all those types of fun things. But for now, what you need to know is if you buy a call, you're bullish. If you sell a call, because you're taking the other side of the buyer, you're bearish, right? If you're looking for the market to go down, the buyer of the option is looking for the market to go up, and vice versa. If you buy a put, you're bearish. If you sell a put, you're bullish. We'll take a look at an example a little later on, and it'll probably sink in. I know when I first started learning options, it was so ridiculous. I would read something over and over and over, and it would just take so long for something to sink in. But once I actually started doing it and putting transactions through and kind of, then it just comes to you right away, and you think, oh my gosh, that is so easy. Why did it take me so long to realize what was going on? So that's just how options are. Trust me, when you start practicing or paper trading or doing those sorts of things and you see prices move around, it really becomes second nature. What is option premium? Option premium is nothing more than the price of the option. It's the price paid by the buyer to the seller for the right to buy or sell the underlying futures contract. There's a few things to know about the premium. The higher the market volatility, the higher the option premium is going to be. It makes sense. If a market is volatile, the option to buy or sell at a specific price is going to be worth more, right? Because if the market's moving quickly, the chances of it being beyond your price is higher. So you're going to pay more for that. You're going to pay a premium. If there's more time to expiration, the option is going to be more valuable, and that makes sense too. If your option expires in 5 days, only so much can happen in 5 days. But if your option expires in 30 days, just about anything could happen. I mean, remember last year in August when the U.S. credit rating was downgraded? Market moves that we thought we would probably never see in gold and some of the other financials were happening. So I recall people with short puts in the S&P or short calls in gold really had a tough time with those types of moves because, uh-oh, sorry about that. Another thing that influences the price of an option is market demand. If people think that there's a higher chance of something happening, they're going to buy the options and they're going to bid the prices up. You see that today in the grain market. I don't know if anyone follows corn or soybeans or wheat, but there's a USDA report out tomorrow. Even though the markets were relatively quiet today in the grain markets, the options actually gained value, and that's because people are playing the report tomorrow. They're looking for cheap options, basically lottery tickets. They're buying calls, they're buying puts, and they're hoping that when the news comes out tomorrow, the market goes crazy and their options become more expensive so that they can sell them at a profit. Sorry, I think I might have missed a question somewhere in there. I guess I apologize. I guess we'll have to catch that at the end.
There was actually two questions. I'll ask them real quick. Ethan says, is premium
Right.
equivalent to a spread? Are they the same thing?
No, premium is really just a fancy word for price. It really is. So like, let's say the $100 crude oil call that we were talking about a little earlier. I don't have prices in front of me, but let's say a December 100 call is probably going for about $1,000. So if it costs you $1,000 to buy that call option, that $1,000 is the premium. The $100 is the strike price. So crude would have to be above the strike price of $100 for that option to be worth money at expiration, because you're buying the option to buy the futures contract at 100. But the premium itself is just the price of the option. It's $1,000. And just like anything else, if you pull up a quote screen and you're looking at a futures price, you'll see crude go up and down as people are buying or selling. The option price is the exact same. I mean, an option might be worth $1,000 right now, and then it might be worth $900 an hour from now, and then it might be worth $1,100 at the end of the day. That's just how the option prices work. And like I said, they're fluctuating with the things that I mentioned before: volatility, demand, but probably most importantly, they're fluctuating with the futures market. As crude oil goes up, the value of call options go up because it's more likely that those call options will actually pay off to the buyer.
And these,
so in other words, simply put, premium is just price.
and these options, as far as like session times, are we talking about like a regular trading hours, or is it possible to buy and sell options, and what would the equivalent of like the Globex overnight market? How does that work?
Okay, that's a good question. I can't speak to the stock side of things because that's not my forte, and I'm not sure exactly what the trading hours over there. But on the futures side of things, it gets kind of confusing because the option markets are, in theory, open almost 24 hours a day. They trade basically in most markets side by side with the futures. So like if you're familiar with the futures markets, most of them close for about an hour or 2 hours a day while the systems are reset. The options are the exact same thing. So they're available somewhere between 20 and 22 hours a day in most markets. But they're not always liquid. So a lot of markets, like if you look at crude oil options or gold options overnight, the market's open. You can see that, there's something going on there, but there's no market makers, or at least there normally isn't. Sometimes if there's an event going on, the market makers will work overnight, but normally not. So if there's no market makers, what you'll see is you'll see crazy bid-ask spreads. Like you might see a crude option 10 cents bid at $2 or something ridiculous, which equates to $100. You could sell it for $100 or you could buy it for $2,000. Obviously, you're not going to want to trade in those type of circumstances. So, but if you're talking about the grains or the E-mini S&P or treasuries, they have market makers around the clock. So you're going to see slightly wider spreads in overnight markets. Like if you get up at 3 in the morning and you look at the option market and treasuries, you might pay a tick extra than what you would pay if you were buying it in the official day session, but it's still extremely tradable in a very viable market. So it's kind of, unfortunately, there's not a black and white answer to that.
Okay. And if my next question is covered in the presentation, just let me know. But as far as like the futures options, futures contracts have expiration dates. I'd like to ask about the expirations of options, and also on the equity side, if there's also expirations for the options there, or is it different because it's the equities market?
Right. The options are always going to have expiration dates, and that's just simply because by nature the the option is determined by basically, in other words, an option is an agreement between a buyer and a seller to give the buyer the right to buy or sell the underlying asset at a specific price and at or before a certain date. So options are always going to have an expiration date. Stocks obviously don't expire. And we're going to touch on that a little bit, but let me just say that in the futures market, you're absolutely right. The options expire and the futures expire too. So it's not like you can construct a strategy like in stock trading. A lot of people will sell puts and they'll say, okay, I'm selling a put on Amazon because even if the market drops beyond my strike price and I end up being assigned and I'm long the stock, I don't care because I want to be long that stock in the long run anyway. But in futures, it's a little bit different because you could sell a put and you could get assigned, but depending on the market and the situation, you may only be able to hold it a week or two. So it's not like you're getting, oh, I can just hold on forever and wait for it to come back type of situation. So it's,
right.
You have to, it's treated a little bit differently.
Right, and that's where we get the terms triple witching and quad witching, right? Everything comes together and
right.
expires all at once.
Exactly. Right, exactly. Is there another question? I thought I saw the thing light up.
Oh yeah, Kathy says, why is it that equity options gives one so much more variety in terms of what to trade?
Well, here's probably, and there's probably not a really book-worthy explanation for that other than think about it. Everybody and their dog that trades stocks in some way, shape, or form. They either have mutual funds with their retirement accounts or, they're buying or selling stocks in a little, personal account. But you probably don't know very many people trading futures. The percentage of people that trade futures as opposed to trade stocks are minuscule. And so for that sheer reason, in commodities, there's really only I would say there's probably only about 20 commodity option markets that are liquid enough to give people the, decent odds of success in their trading. There's a heck of a lot more option markets that are listed on the commodity exchanges, but you start to deal with illiquid conditions, which mean bid-ask spreads are really wide, which means, you might as well just go down to the casino and play roulette, because when the bid-ask spread gets wide, you just have very little room for error. You have to be ridiculously right, and even if you're right, chances are you might not even make money. So you want to stick with liquidity, and unfortunately it's only about 20 markets, but I would say 20 markets is probably enough. Most of the traders that I know focus on 5 or less. If you try to spread yourself out to anything under the sun that that's out there, sometimes it's hard to keep up with everything, and you might not be doing all the due diligence and homework that you should be doing.
Right. And at the top of the webinar,
that's my opinion.
You said that there's limited risk, and Joseph's question is that in stocks, you can use stops to protect your limit. So I'm willing to bet that your presentation probably covers this, but do you have examples that would cover how you're limiting risk with options?
We're not going to get into too much detail about that just because it's a beginner's course, but that's exactly right. Options can help limit your risk. Like, for example, we've put, to our clients, we have a newsletter that we put out trading recommendations on. And one trade that we have kind of gone back to over and over is in the 5-year note futures, because they just don't move fast and the options are cheap. You can do something like, like right now we don't have anything on, but hypothetically, maybe if the Treasury market rallies a little bit, we might be interested in playing on the, being bearish. And what we might do is sell a 5-year note futures contract, but not place a stop order, because I can't stand stop orders. I'm not saying you should just trade naked and, just let the risk do whatever it wants with you, but I like using options instead of stops, because the problem with the stop is, and if anyone that's ever traded, they've experienced, they put the trade on, they place their stop, market hits their stop, and then immediately ends up going the direction that they wanted it to go in the first place. So not only did they lose on the trade, but they had the, the horror of watching it go their way and them not being in the market to participate in it. So what options do for people is they give you a chance to protect yourself without actually having the risk of being taken out of the trade. You might lose on the trade, but at least you know no matter what happens, you're still going to be in the trade, and there's still a chance that the market could come back for you. And what I mean by that is, let's say that we sell the 5-year note I was talking about earlier. We might sell the future, and then we might buy a call option, which, remember, the call option is the right, but not the obligation, to buy the futures contract at a certain price. So we'd buy a call option at the money or maybe a little above the money as our insurance. Basically, that's going to insure us if we're wrong. And a lot of times we can get into a trade like that to where our risk is under $500. So we're short the future, we have unlimited profit potential, but our risk is limited to, you know, whatever it happens to be, about $500 or less. And the market could rally 4 handles on us. We're still in the market, and we could, you know, we're not going to be stopped out. We just might lose our $500, but at least we can hold on and hope for a miracle, and maybe things will get better. So it just avoids the hassle of getting your stop hit prematurely.
Right. And we might be getting ahead of ourselves, so just let me know if you want to wait to answer this next question. So you just mentioned a couple of terms: at the money, above the money. There's also what, in the money, out of the money. Can you define those for us?
I can, yeah. Actually, it'll probably be easier when a couple slides from now I have a picture, and it'll probably be easier there. So we'll do that then. All right, I'll go ahead and see if we can get back on track here. All right, the idea of buying and selling options is you want to be a net buyer of options when volatility is low, when nobody's looking, when the market's quiet, when there's low demand for options, which equals cheap premium. In those instances, sometimes buying options is not such a bad idea. Again, I think I mentioned this earlier, but I look at buying options as kind of lottery tickets. Every once in a while you're going to hit a big jackpot, but most of the time you're not. Most options expire worthless, so you want to be careful when you're buying options. I'm not saying don't ever buy options, because that's not true. I just told you a few minutes ago you can buy options for insurance, you know, to protect a futures trade. And sometimes you can buy cheap options just as a pure speculation, you know, lottery ticket type play. Sometimes those things make sense, but more often than not, you're probably going to want to be a net seller, which means at least for every one option you buy, you probably want to sell at least one, maybe 2, or, you know, a strategy that we even like to use is being a net, actually just an option seller, not buying options but selling them outright. The difference is, you know, as an option buyer, again, you're buying lottery tickets. As an option seller, you're basically, you know, the state of California selling lots and lots of tickets, and eventually you might have to pay out a jackpot here or there, but hopefully you're ahead in the long run. So that's the basic idea of it. You want to be a net seller of options when volatility is high, when demand is high, when everybody thinks that, you know, crude oil is going to the moon. That's when you want to try to sell calls. If everybody thinks that the E-mini S&P is, you know, about to take a dive to wherever, 700 again, like in 09, you know, that's when you want to sell puts. So you just have to keep in mind, if the demand is high and everybody thinks the market's going one way, sometimes you can look at the option pricing and see that things are out of whack and things are overpriced, and that's when you want to be a net seller. My favorite quote of all time is Warren Buffett, and he said, "Be fearful when others are greedy, and greedy when others are fearful." And I think that sums up just about any trading strategy I can think of. Okay, why trade options? Well, options are versatile. Options can be anything that you want them to be, and that's the great thing about options. If you're risk averse, there's something for you there. If you're aggressive, they can do that too. It just depends on how you as the trader structure them. And it takes a little bit to get used to how options work and how you can put them together and do different types of strategies. And in the next webinar, we're going to get into more detail on that. But for now, I just want you to understand that options don't have to be lottery tickets, and they don't have to be, you know, straight premium collection where you're selling options. They can be a little bit of both. And we kind of mentioned this before, but I want to really drill this into you, because a lot of people start doing options and then they kind of forget the fact that if you're buying options, your risk is limited, which means there's no margin. If you buy an option, there's no margin on it, because you can never lose more than what you pay in premium to get into the trade. and there's unlimited profit potential. But as an option seller, there is margin because you have unlimited risk and you have limited profit potential. Now, everybody looks at short options and they think that, you know, it's a horrible idea. Who would sell an option for a small amount of money with unlimited risk? Well, the idea of it is what I just told you. You're probably, as an option seller, you're probably going to win more trades than you're going to lose. In fact, it's probably going to be a pretty high percentage of winning trades. But you have to make sure that the 10% that you lose or whatever it is doesn't wipe you out, because it can happen. And it's, I'm not telling you that just sell options, it's an easy game. I'm telling you that the odds are in your favor as an option seller, but you have to be careful. You can't just blindly sell options and expect to come out ahead. Now, option spreads are popular because you can kind of take the best of both worlds. And option spreads is a really wide term. I mean, an option spread might be selling a call and selling a put. It might be selling a call and then selling a call and then buying a call higher with a higher strike price, or it might be buying a call and, I mean, you get what I'm saying. It could be basically an unlimited number of combinations. And while we aren't going to have time to go through each of the strategies and tell you how options can do this, I want you to understand that options can help traders reduce volatility, mitigate or limit risk. They give you more room for error and higher odds of success, and I'm going to kind of show you that on a chart example real briefly. But the reason I like options is they minimize the emotions and the challenges that come with trading futures. I mean, we all know if you're trading futures or stocks, whichever the venue you're in, and you buy a futures contract outright or you buy a stock outright, you're immediately making or losing money. There's no room for error. It is what it is. You're long or you're short, and you face the consequences. In options, it's not necessarily that black and white. In fact, if you're an option seller, sometimes you can sell options and be dead wrong. You can sell a call option in a market that you think is going to go down. The market can go up, and you can still make money. Now, the buyer faces the opposite. Sometimes you can say, I think corn's going up. I'm going to buy a call option. And the market does go up, but your call option loses value. And that happens because of time value erosion. The thing about options is timing is everything. Just because the market goes in the direction you want it to doesn't mean that the option is going to gain value, because as each minute that goes by, that option is becoming less and less valuable, because the less time there is for your specific event to happen, the less valuable that option is. The opportunity cost of having all these benefits of options is there's probably less profit potential. For the most part, I would say that's definitely true. Not always. It depends on how you structure your option spread or how you do it. But more often than not, if you're taking on less volatility and less risk, you're probably giving up profit potential. But that's not such a bad thing in my book, but everyone looks at things differently. There's two ways to look at option trading. There's base hits and there's home runs. If you're the kind of person that's okay with base hits, small winners, but probably more frequent winners and better odds of success winners, then option spreads and short option strategies are probably the best direction for you. I mean, obviously, home runs attract all of the attention, but it's really base hits that win the game. Really? If you happen to be an egotistical trader, you're probably not going to be a good option seller. And this is just a general warning that I felt compelled to throw out there, because if you're that type of an aggressive trader and it's all about ego, you can't be looking for the big one when you're an option seller, because if you do that, you're going to end up getting too close to the fire and you're really going to get burned. If you're that kind of trader, you might want to look at the home run strategy, which is, or what I call lottery tickets, is just buying options. Now again, when you buy an option, your odds of success are not that great. But if you happen to be at the right place at the right time, I mean, it's a great way to get into the market with limited risk and unlimited profit potential. Sometimes they pay off big. I've seen crazy things. I've seen traders I saw one particular trader, and I probably told the story way too many times, but I've seen a trader take a $10,000 account. This is back in 2008 when the stock market sold off very sharply. He took a $10,000 account. He bought a bunch of put options in the E-mini S&P. And I'll be quite honest, I kind of thought the guy was nuts. He was buying deep, deep, deep out of the money options that had very low probability of success. But he proved everybody wrong. He took a $10,000 account to $500,000 in about 2 weeks. So those types of things are possible. They don't happen often, but it can happen. And that's why, that's what makes option trading so exciting. If you want to be the guy that's, putting all your money down on one play like that, you can buy a bunch of options. If you want to be a guy that tries to play the opposite angle where you're the house and you sell premium here and there and hope that you don't have to pay off a jackpot, you can do that too. And you can be anywhere in between.
That actually raises an interesting question that I have for you, Carley. How would you describe leverage when it comes to options? I mean, is there an equivalent leverage like margin in stocks and futures? Margin and leverage. Is there something equivalent that would translate into the options world?
Well, the thing about, I don't know, there's really not an effective way to measure it mathematically, or at least my brain doesn't work that way. But
I mean taking 10,000
is leverage on leverage. Like when you're buying an option on a
right. I mean, your example, 10,000 to $500,000. That to me, I'm going, oh my God, what kind of leverage are we talking about?
Right. Well, here's the thing: when you're buying options like that particular trader, he basically bought several puts. It wasn't like he bought just one option. He bought a whole bunch of them deep out of the money. He used just about the entire $10,000 account. But the reason he was able to build it up, and he actually traded in and out a few times, like he made money on the puts, and then he bought calls for a day and made money there, and then he bought puts again. So, I mean, it wasn't like just a straight outright play. But the reason that's possible in futures, I would venture to say it's probably not possible in stocks, but I don't know enough about stock options to really say that. But the reason it's possible in futures is because when you're buying an option, the option itself is leveraged because you're paying, this particular guy was paying like $250 or $300 for options that were deep out of the money that most people would have said would never pay off. The odds of them paying off were probably 1% or less. I mean, this is like just such an outlier. But for $300, when the market did start to sell off and everything got crazy, his $300 buy-in gave him the ability to eventually, his options were in the money. So for $300, he ended up, controlling a contract that was worth at the time probably about $50,000. So this is a very extraordinary situation. Obviously, you don't see that very often. In fact, I've been a broker since 2004, and I'll probably never see something like that again. That's why I'm still talking about it in 2012.
Right. But it gives a good example.
I mean, it just gives you
right. So he basically paid almost his entire $10,000 was basically consumed from all the different trades he was making for the cost of the option itself.
Right. So in other words, I mean, I don't have everything in front of me, but let's say, for example, he paid $300 per option. So basically he bought 30 options. Let's just call it 30, round it up. So he bought 30 put options in the S&P deep out of the money at prices that probably should have never been seen, but they were. And so that's how he was able to make a ton of money, because for $300 he had the right to sell. Let me just pick out random prices. I don't know exactly where the market was, but let's say he bought 1,000 puts in the S&P, okay? And the market was trading at, I'm just going to say 1,300. I don't know where it was. I would have to pull up a chart. Somewhere in that general ballpark. It's probably quite a bit lower than that. But anyways, so he buys the options. The market's at 1,200. Let's just say 1,200. And most people think, no way it's ever going to hit 1,000. So the options are cheap. Well, for $300 a pop, or $10,000, he bought 30 of them, of the 1,000s. And let's say the market dropped to 950. Well, all of a sudden, in the S&P, each S&P futures, is worth $50. So he could have, he basically, this is where it's going to get confusing for those that aren't used to option trading, but for that $300 buy-in, he bought the right to sell at $1,000. Well, if the futures are trading at $950, his right was worth at least 50 points, probably more because the volatility was high. So even though he didn't necessarily exercise it and go short the futures from 1,000, because that's not a good idea, and I'll explain why later, but he could have sold those options, and again, this is kind of hypothetical, but he could have sold those options for at least 50 points because they're worth 50 points intrinsically from 1,000 to 950, and they probably had some more value built into them because they weren't, there's still timed expiration, the volatility's high. So he might have been able to sell those options for 70 points, 75 points. To make a long story short, for $300, he ended up with an instrument that was equivalent to being short a futures contract from 1,000. And so
right. Okay.
You can make a lot of money real quick on something like that.
That's a good example. It makes it easier to follow.
Okay, good. So anyway, it's leverage on leverage. So if you happen to be in the right place when you're buying an option, it can pay off huge. But most if you want 99.999% of the time, that's not going to happen. It's usually much, a boring, slow process, and the option dwindles from $300 to zero. But that's just, that's trading. There's never going to be any perfect strategy. So you just have to kind of look at the odds, and what I try to do is, like I said, I am an advocate of being a net option seller as opposed to a buyer because most options expire worthless. But you have to just find what works for you and what strategy works for you and what strategy works for the situation, because all situations are different. Okay, a lot of people ask me, this is my favorite question, and it's the most difficult to answer. A lot of people will say, okay, Carley, if I buy, a call, let's say if I buy a 1,500 call in the S&P, and the market goes to 1460, how much is it going to be worth? Well, the answer really is impossible to predict. If the market is at 1460 at expiration, you make nothing, right? Because you bought a 1,500 call and the market's only at 1460. So you lost your money, you lost whatever you paid for that option, it's gone, it's pixie dust. But if you buy a 1,500 call and the market rallies to 1460, but there's still 45 days to expiration, let's say your option doesn't expire for another month and a half, you know what, you might be making some money. So your option might have picked up value and you're probably making money, even though the futures price never hits your 1,500 call. The point I'm trying to make is, at any time before expiration, it's impossible to judge what the option price might be or what it's going to be when the market does something, moves in a certain way. Right.
And just to follow up with that example, could you tell us roughly, like let's say today, what market's trading 1425. Let's say you want to buy 1,500. You think it's going to go to 1,500. What would that option cost? Just as a rough example.
Let me just take a peek at the quote board here, and I can give you an idea.
Okay. So I think that makes it better for people to understand what kind of money we're talking about for something like that. And the cost is going to change, right, every day closer to expiration. Right.
Right. It will, and it's going to change with the market and with the time and all those types of things. But let's just say a December option, which has 73 days to go. There's 73 days to expiration, which is quite a long time. If you bought a 1,500 call, it would cost you $8 in premium, which is $400 in real money in the S&P. So for $400, you buy the right to possibly buy the future at 1,500 if the market goes up. Of course, you wouldn't want to buy it at 1,500 unless the market's trading higher than that. But just because the market never gets to 1,500 does not mean that your option won't gain value. If we rally 10 handles tomorrow, your option will probably pick up. Again, this is so you can never measure this because it depends on volatility and demand, and those things you could never measure. But probably going to be, if you buy it today for 8 and the market goes up 10 tomorrow, you're probably looking at picking up $2. So it'd probably be, it'd go from $400 to $500 in premium.
Okay.
But at expiration, you can calculate how much you would make or lose to the exact penny. And we can do that through a break-even calculation that's very simple. When you buy an option, it's the right to buy or sell at the strike price, but before you ever make a penny on it at expiration, you have to overcome the premium that you paid plus any transaction cost. So as an option buyer, if you buy a call option, let's say the 1500 call that we just looked at for $8, if you hold it to expiration, the market would have to be above 1508 for you to ever make a penny on it. Because first of all, you have to cover the $8 you paid in premium to get in, right? And then above 8, you actually start making money. So it's possible for your option to be in the money, meaning that it's beyond your strike price, and you to still not be making money. Like if we're trading at 1505 at expiration, you're still losing money, even though the market got to 1500 just like you said it would, but you paid $8 to get in, and it's only $5 above your strike price, so you still lose.
Right, and this, okay.
Which is why.
Is it equal to like one contract? I mean, one option is equal to being long one ES contract. I mean, yes, I can call in one. Okay. Okay.
Yes, that's a good point because I forget about that. In stocks, everything's done with 100 shares, but in futures, it's a 1-to-1. So if you're buying an option, it's based on one futures contract.
So let's say that I wanted the ability to be able to call in 10 contracts. I would buy 10 of these options for $80 is what you're saying. And
well, it's okay. It's $8 in the E-mini S&P.
Right.
Yeah, so $8 is actually equal to $400 because you multiply it by 50 because each point's worth $50.
Right. Okay.
Okay.
Okay. And then I would if the S&P is trading at 1508 and higher before the expiration, then whatever the difference is, I could get back again using that $50 per. Is that right?
Right. Okay. Yes. At expiration, yes, that's absolutely true. Okay. So if it's trading, let's say that it's trading 1510 at expiration. Okay, you paid $8 to get in, so basically your option will be worth $10. So you'd make a $2 profit is what would happen.
Okay.
But before expiration, you could actually be making money whether the option or the futures price ever gets to 1500 or not. Like I said, if you buy it today and the market rallies 10 handles tomorrow, your option will be worth a little more because people recognize that there's a higher chance of the market getting to 1500 tomorrow if the market's 10 handles higher than they did today, 10 handles lower, if that makes sense.
Okay, great.
All right, I think the next slide is a chart, and I think it might be a little easier. Yeah, okay. So this is actually crude oil, and this is just to kind of give you an idea of the odds and how to calculate the break-even for a long option. Now, the buyer of a call option only profits at expiration if the futures price is above the break-even point. Now, remember, I told you for every buyer there has to be a seller, right? So if the buyer makes money above the break-even point. I don't know if you can see my cursor or not. Possibly, hopefully.
Yes, yeah, we can.
Okay. All right, so the buyer makes money above the break-even point, but the seller makes money at anywhere below because remember they have the opposite profit payouts. So let's say that this person buys a 105 call in crude oil. They're saying that they think crude oil is going to go at least to 105 and hopefully beyond because they spent $2 in premium for this option. Again, I would never recommend anyone do something like this, but just for example purposes, $2 in crude oil is $2,000, just to give you an idea. That's a lot of money, especially for a lottery ticket. I mean, I don't mind buying a $5 lottery ticket at the gas station, but $2,000, that's a little crazy. So for $2,000 or $2 in premium, someone could have bought a 105 call. And here's the 105 strike price right here. This is where their option goes in the money. An option becomes in the money if the futures price goes beyond the strike price of the call. So it's a 105 call. Above 105, the option's in the money. But just because it's in the money doesn't mean people think that in the money sounds like you're making money, but that's not how it works. It's in the money intrinsically because the futures price is above the strike price, but you're still not really making money, or at least not at expiration, until we hit the 107 area, which is where you basically break even because you finally recouped what you paid to get in, and then above that you make money. Now again, this is at expiration. At any time before expiration, all of this right here is out the door. it's certainly possible if someone pays $2,000 for an option right here and the market rallies to 102, never gets to 105, but it rallies to 102, but it does it fast enough that there's still some time value left on the option and buyers are still willing to pay a good price for it, it's very possible that they'll actually make money with the market never reaching 105. But remember, you'd have to sell it before expiration. You can buy or sell an option at any point. You don't have to hold it to expiration. In fact, I would probably tell you, you probably don't want to. 99% of the time, you don't want to hold to expiration. You're going to want to sell it before that.
And just to clarify these prices, so for crude, it's $10 a tick, so $1,000 a point, and that's where you're getting the $2 premium equals $2,000, right?
Exactly,
okay.
Right. That's exactly right.
I want to make sure I had that right. So like, let's say you want to do it on the euro dollar 6E, then $12.50 a tick.
Exactly.
Okay, thanks.
Yep, no problem. And so I just wanted to point out too, remember when we said if we're buying an option, your risk is limited, but when you but your profit potential is unlimited. Well, you can see that the limited risk, I mean, no matter what happens, if crude goes to $70 a barrel, you're still only going to lose the $2 you paid to get in, which is $2,000. So that's the nice thing about buying options. But I would rather be the seller of this option, because if you look at it this way, it's true that above 107, you have unlimited risk, which, think about it, unlimited risk sounds really scary, and it is. But it's no different than having a futures contract on, right? When you buy or sell a futures, you have unlimited risk. So here it's no different. It's like being short a futures contract above here. So as an option seller, look at how much room for error you have. At this point, you might say, I'm going to sell an option because I think crude's going down, and I would say that would probably be a pretty good trade. I think it did probably peak out right about here. But look at the odds, or look at it from this standpoint. The market can go up, it can go down, or it can go sideways, and the seller of that option would make money. That person would collect $2,000 and keep it as long as the market stays below 105, and they would keep most of it as long as the market stays below 107. So you can see why I think option selling is maybe not such a bad idea, even though it gets a bad rap. A lot of people, you say the word option selling and they cringe and they get all crazy and sensitive. But from an odds standpoint, it's actually a very good way to look at things.
And this, you said earlier, I believe, I want to make sure I got this right. This is you recommend overall to be a net seller of options. Am I right?
I do, yes.
Okay.
I'm not saying never buy options, because sometimes, like if a market's super quiet and nobody's paying attention and nothing's happened in a long time, sometimes the options get really, really cheap, and it's worth it. You can, for a couple $100, buy an option and see what happens. If worst case scenario is you're out a little bit of money, and best case scenario is you happen to be in the right place at the right time. So there are times to buy options, but this is my opinion, but I think being a net seller is probably your best bet. And one thing that we can talk about in the next class also is you don't necessarily have to sell options naked. You could buy or sell futures and then sell options against it. It's kind of similar to covered calls in stocks, but in futures, because you're talking about leverage on leverage, it's a little bit different. I would say in futures, you probably want to sell at least 2 options for every futures contract you went long. So, shoot, I wonder if I can go back. Let me see. Yeah. Okay, so if this trader was bullish at this point, which I'm not sure why they would be bullish at this point, but let's say that they were, they might go long a futures contract, but they might decide to sell the 105 call to hedge themselves, and they might even sell 2 of them. So they can go long here and collect $4,000 in option premium, and that $4,000 in option premium cushions them on the downside. So like, let's assume that they hold it to expiration. The futures price can actually be $4 lower than where they buy in. We'll just call it about 96, and they're going to break even. They didn't lose a dime even though they were wrong by $4. So you can use options and option selling as a hedge as opposed to just an outright premium collection strategy. We'll get into stuff like that probably in the next class. All right, I'm just going to real briefly kind of point out the differences between stock options and futures options, because I know we have probably a little bit of both types of traders here, and I just want you to understand the difference. I mean, not all options are created equal. It's true, a call and a put are always going to have the same kind of mechanics and the same types of overall rules, but each marketplace, stocks versus futures, they have different characteristics that you should be aware of so that you know which, if you're switching from one venue to the other, you need to know what the differences are so you can plan accordingly. Okay, commodity options, we kind of talked about this a little bit, are leveraged. They're written on leveraged assets. So again, it's leverage on leverage. There's more risk, but there's more potential reward as well. I would say, and again, it's hard to compare apples and oranges, so that you're probably never going to find anyone that could mathematically give you an answer to this, but I would venture to say that options on futures are a lot more, maybe not a lot more expensive, but they are more expensive than options on stocks, and the reason being because the underlying asset is leveraged, and so they're worth more.
So let's say that you have the option to do both. You could trade crude or you could trade USO options. As far as the cost of the premium, and I mean, normally it would be better to trade futures than USO, as long as you're wanting to trade that large of a size of at least one contract. Is that still true for the options?
I would say yes.
Right. I would assume so.
Of course, you're going to want to do your own homework on that. I'm not a
I know.
expert, so to me, I don't want to lie to anybody.
Right.
Right. But I would venture to say yes. My thought on ETFs and things like that are, as long as you have the margin, and the thing that people don't think about when they trade futures is futures markets offer a lot of free leverage, and that's great. But that doesn't mean that you have to actually use the leverage. I mean, a lot of people choose ETFs because they move slower and they don't have margin and things like that, or if they do have margin, it's probably a lot less than what it is in the futures. But in the futures market, like let's say for crude oil trading at $90 a barrel, basically that's worth, let's just call it $90,000 is the contract size. Well, if you want to completely eliminate the leverage, then you fund your account with $90,000 and you trade one contract. So just because the market gives you leverage doesn't mean that you have to use it. So I just want to point that out, because a lot of people, they think, well, the margin's only $6,000 in crude, so that's what I should be trading crude with, and that's not necessarily the case.
That's rarely the case.
yeah, you wouldn't want to do that. But so it is what you make of it, I guess, is what I'm trying to say. But I would, as an option seller, I can tell you that what I've found and talking to my clients and other traders is you tend to get much better treatment for margin purposes as an option seller on commodities as you do stocks. I know a lot of stock accounts, they require you to apply for special access to sell options, and they might ask you to have a $100,000 account, and if you have under $100,000 they might let you sell options, but they might do it on restriction, and they might charge you higher margins and all those types of things. In a futures account, you can sell options with very little money. Like just to give you an example, we put out a recommendation for our clients last week to sell crude oil strangles. There are 104 calls and 80 puts and 104 calls. And the margin on that's only like $1,600. So in theory, I'm not saying this is what you should do, but in theory, if you have a $2,000 account, you could sell a crude oil strangle, and I can guarantee you a stockbroker wouldn't let you do that. So it's just something to think about.
A couple questions here. Mark's asking, sure, do you have any recommendations on what market you think is best within futures options? And the second part of his question is, can you talk more about how to choose the correct strike in expiration month?
Yes. Okay. These are good questions. My feeling on which markets to trade in commodities are stick with liquidity. I mean, there's no reason to force something if it's not there. So let me just tell you this. You're going to want to stay away from things like lumber, rough rice. You hear about these things on TV, but you really don't want to trade options on them. The my favorite markets are the E-mini S&P because they're E-mini S&P options are ridiculously liquid. I mean, the bid-ask spreads are tight, and you can trade them 24 hours a day. The Treasury options are very liquid. Euro, which is the 6E in the future side of things, super liquid. I don't mind seeing traders get into like the yen or the British pound or maybe even the Aussie and the Canadian every once in a while, but you want to probably do those markets sparingly. Crude oil is a great option market, but if you want to stay away from natural gas and RBOB gasoline. If you look at the thing about RBOB and natural gas is if you look at an option quote during the day or if you look at volume figures, it looks like there's tons of liquidity. You'll see thousands and thousands of contracts on each strike price. But what you don't understand is those aren't retail traders like you or me or whoever. They're institutions that are hedging or even big funds that are trading hundreds or thousands of contracts at a time. So the liquidity for an individual trader trying to do a one lot or a two lot is it's just not there. The grain markets are great option markets, so corn and soybeans. Wheat's a good market, but you want to do that maybe a little less frequently than corn and soybeans. And
Okay.
I would say.
And then choosing the strike and expiration.
Like meats and softs.
Sorry about that.
I was
Go
pretty
ahead.
much done. That's okay, no problem. Meats and softs, if there's a good opportunity, go for it. Otherwise, you don't want to be paying too much attention to those markets, for options anyway. Picking a strike in time horizon, it really, I mean, I guess it depends on really what type of trader you are. If you're more aggressive, you're going to want to choose strikes near the money. If you're less aggressive, you're going to want to choose strikes out of the money. And it also depends on what your goal is. I would say in general, like me with my personality, I actually go for the deep out of the money strikes usually as an option seller. Like I mentioned, the trade I recommended to my clients was an $80 crude put and a 104 call. So I mean, you can see we're giving, at the time we put the trade on, we had $12. There's basically a $12 difference between the futures price, the price of crude, and our strike prices. So we're giving ourselves the ability to be, the market could be in a $24 range and we get to keep our money, number one, but number two, we can be wrong by $12 on both sides of the market and still make money. So those are the types of things that I look for, but
Right.
Other people are more aggressive and they might have gone with 100 calls and 85 calls.
Let's say like the S&P mini right now. I mean, I could trade December 2013 contracts right now. So I'm assuming I could trade the same thing on the options market. Now, is that, I mean, let's say that December 2012 versus December 2013, does that make my my 1500 price target on the S&P, is that something that makes it more expensive or less expensive since I've got so much more time?
Right. The more time you have, the more expensive the option's going to be. And actually, I'm glad that you brought this up because I don't think of things like this because I'm so used to commodities. But I know stock option traders look at options a year out or 2 years out, that the leaps that have tons of time on them. In commodity options, you really probably don't want to go beyond 3 months. Most of the option trades that our clients do are within 45 days to expiration. So like anything going out into 2013 is probably not the greatest idea. And the reason being, for whatever reason, who knows why it is, but speculators really just don't go out that far in the commodity markets.
And now what's the least amount of time?
The grains are an exception because the grains are based on cycles.
But like crude expires, monthly, right?
Idea,
so can I do an option that expires tomorrow, or is it always going to be on the expiration date of the next contract, the next front month?
Well, crude oil, the November options for crude expire in 8 days. So like for crude, you could trade options that expire in 8 days, which is actually an interesting idea because if you start getting into options that only have a couple of days to expiration, they start to get cheap, and you could use that as a substitute for the futures trade. Like for example, let me see what an at-the-money option would be. Well, they're still pretty expensive. But an at-the-money option in November crude that expires in 8 days is worth about looks like about $1,500. I still think that's crazy expensive, but anyway, the idea is in crude oil, you're right, there's a contract every month. So there's an option that expires in 8 days, and then you can go to the December options, which are the options that our clients have on, and they expire in about 30. Normally, I would say you probably want to stick with options that have 50 days or less to expiration. It's just my personal opinion. Like for instance, you mentioned the like if you wanted to go out to 2013 for the E-mini S&P options, they actually haven't listed the December E-mini S&P options for 2013 yet. But you could go to, let me see if they have March yet.
Well, it sounds like it would be a bad idea.
Trade March options, but they're
too expensive.
Yeah, they get really expensive, super expensive. But on top of that, they get, and that's another thing I want to point out too. A lot of option sellers try to do that. They'll go out like 6 months to a year because they, like you said, they're very expensive. So as a seller, they think, well, why don't I just sell this ridiculously expensive option and see what happens? Well, the problem is when you go out that far, the liquidity just isn't there. On a normal day-to-day basis, you might be able to buy or sell it with a decent bid-ask spread, but if something goes wrong, you're dead meat because like if you get a flash crash or U.S. credit downgrade or something that really sparks things up, there's not going to be someone to take the other side of your trade. So you're basically handcuffed into a bad trade, and that can be a nightmare.
Okay.
So, bad idea.
Good.
All right.
There's several questions, but I don't know how much more of your presentation. So I think maybe you tell me. Do we?
Let me just rush. Well, let me just rush through some of this stuff real quick. I think a lot of this stuff is just comparing stocks to options. I think we can get through it real quick, and then hopefully we can answer all the questions. Okay. We kind of mentioned this before. Commodity options are written on futures which have an expiration date where stocks do not. So you want to think twice about putting a strategy together in commodity options in which you don't mind taking delivery of the contract and holding on to the contract because you might not have the ability to really hold it as long as you want to. In most situations, like in crude oil, the options expire about a week before the futures. So you just have to plan that accordingly. Now, just because the futures contract expires doesn't mean that you have to throw in the towel on the trade. You can roll into the next month. So if you're, if you don't know much about commodities, if you're long November crude and you want to stay long, you can just sell your November and buy December. Okay. Another thing to just keep in mind is commodities don't pay dividends. So a lot of stock traders, especially if they're trying to do covered calls and things like that, they understand that they have the benefit of a dividend. Well, commodities don't have that. And because commodities don't have dividends, they don't really have the long-term upward projection that stocks usually have. Normally, commodities trade in ranges, although the last 4 or 5 years have been kind of abnormal for commodities, but maybe this is the new normal. It's hard to say. And we already touched on this as well. Stock option traders, I mean, they can pick between hundreds and hundreds of stock options. Commodity option traders, we really have about 20 to work with. To me, that's enough. I really don't need more than that, but everybody's different. And we actually kind of covered this too with some of the questions. And your time horizon should be, in my opinion, should be about 50 days or less, especially as an option seller, because think about it, a lot can happen in 50 days. So if you start going beyond that, just about anything is possible, and sometimes that anything might not be the best case scenario, it might be tragic. Stock option traders are often going out 1, 2, 3 years. There's liquidity there. In commodities, there's not. You start getting into super illiquid markets if you go out beyond a couple of months. Now, commodity options are traded electronically just like stock options are, but they're also traded in open outcry pits. Those are the pits where they show people waving their hands and yelling and screaming. They do still exist. They don't really trade futures so much in pits like that anymore, but they do trade options. And so it's actually pretty important to to understand that, because you can, in certain markets, you can actually sometimes get better execution in the pits than you can electronically, and vice versa. So it's nice to have access to both of those. So make sure if you're trading commodity options, you might want to ask your broker that, because it definitely can be an advantage. During times of chaos is when it really becomes an advantage. Like during the flash crash, I personally had clients that were trading bond options, and because I had access to the open outcry pit, I could call down and get execution there as opposed to going through the online system. We were able to get fills that were probably hundreds, if not thousands of dollars better than what someone might have got if they were panicked and trying to get out on the electronic system. So it does make a big difference. It doesn't always make a big difference, but if it's, if an event like that only happens once a year or once every few years, it's enough to be worth it. Commodity options traders actually are taxed at a lower rate than stock option traders, so that's something to keep in mind. Obviously, it only matters if you're making money. If you're losing money, then I guess it doesn't matter. But if you're actually profitable, it's nice to be a commodity option trader because you're taxed on a 60-40 blend between long-term and short-term gains. And the best part about it is there's no need for a line-by-line account of activity. When you file your taxes at the end of the year as a commodity option trader, you get one number. It's the bottom line, how much you made or how much you lost, net of fees, and that's it. That's all you report. You don't have to do each transaction. And of course, stock option traders do. They have to report each and every transaction, and I can't even imagine how difficult that must be. The other thing is, if you're trading stock options and you want to sell options or do those types of margin strategies, it's quite possible that your brokerage firm will charge you interest. In commodities, there is no interest. Everybody gets leveraged, and everyone is treated the same. Whether you have a $100,000 account or a $5,000 account, you're going to get the same margin treatment. So it's actually a good place for small speculators to get involved. Okay. This is kind of going to give you a real quick idea. Like, let's say, for example, you're bearish a certain market. Let's say that you're bearish the S&P. There's one of three things you could do. You could either sell a futures contract, you could buy a put, or you could sell a call. If you sell a futures contract, you're immediately facing unlimited risk. You immediately have unlimited profit potential. And if you place a stop order, you have a risk of being stopped out before the market performs as expected, if it's going to. And you also have a delta of 1. And what a delta of 1 means is options have a delta. And the delta is like basically how sensitive they are to the futures changes in the futures price. So obviously, if an S&P drops $1, it dropped $1. That's it. That's what you made or lost in the futures contract. On an option, your delta is going to be at something less than $1. An at-the-money option has a delta of 50, which means for every point the futures moves, the option is going to move about half that. So you can see how options can reduce your volatility in that you're always going to have a delta less than 1. The option is always going to move slower than a futures contract would. One of the other choices would be to buy a put. And with that strategy, you have limited risk, unlimited profit potential, but you have time value erosion. Remember, like I said, every minute that goes by, your option becomes worth less because that's 1 minute less that something can happen. It only, think about it. It only takes one news event or something unexpected for markets to start moving, and every minute that goes by, the odds of that are reduced. The third strategy, which is my favorite, would be to sell a call. So these are all bearish strategies. You sell a future, you can buy a put, or you can sell a call. And like I said, I prefer selling options. And I just wanted to give you an idea of what it might look like on a quote board. This was taken probably a month or so ago, so the prices are probably not realistic. Let's see, S&P's at 1453, so you could sell a future at 1453. Or, you asked me before, how do you pick out a strike price? Well, again, you want to pick out a strike price based on how aggressive you are. These are all put options over here, and these are the bid-ask prices, the bid and the ask. So if you're an aggressive trader, you might want a 1440 put for $16. which in real money that's 1,800 bucks because each point's worth 50 bucks. If you're a conservative kind of trader, you might say, let's spend $7 or $350 on a 1,400. So you can pick how aggressive or how conservative you want to get with it. As an option seller, you can do the same thing. See, if you sell a 1,500 call, you're only going to get $4. That's not much. That's like 200 bucks. If you sell a 1,490, you're going to get $650. So I mean, you can kind of guess. Well, I shouldn't say guess. You can gauge how much risk you're taking on for how much reward you're getting. And what I do is if I'm buying or selling or whatever I'm doing, I always look at support and resistance. It doesn't make sense if you're selling a call, which again, remember that's a bearish strategy, so you'd be basically looking to, let's say we sell the 1,480, you're collecting approximately $9 in premium. You're betting that the market at expiration is going to be below 1,480 or at least below 1,490, which is about where your break even is because you're collecting $9. So as long as the market stays below 1,490 and you see the market's at 1,450, you make something. Your maximum profit comes in below 1,480. So you can see, okay, if resistance is at 1,470, 1,480 would be a great strike to sell. But if resistance is at 1,490, why the heck would you sell a 1,480, right? Because you're betting that the market's going to be below it. So you want to take a look at support and resistance and just use logic when you pick these strikes. This is a kind of a chart of exactly what I just showed you. A futures trader would sell somewhere around 1450. They're immediately making or losing money. Now the great thing about selling a futures up here, and especially in this case, it actually worked out. The market's quite a bit lower now, so that person would have made a lot of money. But they had a lot of risk too. What's to say that they wouldn't have been stopped out here? The market chopped around for a week or so before it actually sold off. A futures trader might have put a stop in and gotten stopped out, and they might even have resold and then got stopped out again. So they might have been right and still lost money just getting chopped out before the market turned around. Or let's say that they didn't use a stop. If they're wrong and the market goes the wrong way, they're facing a lot of risk. A trader that sells at 1460 would suffer a loss of 1,500 bucks on a rally to 1490. So they don't have a lot of lasting power. But if the market drops to 1430, which it did, they'd make $1,500. So in this, now that we know what happened, I mean, obviously it's easier after the fact, selling a futures contract would have been a great idea. But as a futures trader, you're facing bigger risk, bigger reward, but lower odds of success. And I know we're kind of running low on time, so I'll try to hurry through these. The third option would have been to buy a put. As we mentioned before, a put buyer doesn't really make money until at expiration, again, this is at expiration, until they recoup what they paid in premium. So if someone paid $10 for a 1420 put, assuming that they're still holding on to the option, they were right, the market dropped, but they wouldn't have made any money because the market right now is trading, where are we, 1425, somewhere in that range. So again, buying an outright put, it's great in that you have limited risk and unlimited profit potential, but the odds of success are pretty dismal. And it's really frustrating to be right and still lose money. There's a big difference between being right and making money, and it's all about how you play it and how you approach it. As I said before, I tend to be an advocate of option selling, and that's because this trader would have made money, now far less, as we now know this trade worked out, and they would have made far less than the futures trader. Remember, he made about $1,500. An option seller would have made about 500 bucks, but just look at how much less stressful it would have been. You didn't have to worry about stops. You didn't have to sweat it out when the market was chopping around. You sold your option, and you knew as long as it stayed below 1480, you got to keep the $10 in premium, which is 500 bucks. As long as it's below about 1490, you make something. That's your break even. So the odds of success are really big in this type of a strategy, but you face unlimited risk. think outside of the box. Open your eyes to the potential of both long and short options. Most speculators, again, are lured to long options because limited risk and unlimited reward, but it's not always the best option. There's at least 4 reasons why you should consider some sort of an option spread strategy or maybe even outright short options. And that's time decay. Options are an eroding asset. Every minute that passes reduces the value of any given option. It's kind of like buying an option, or sorry, kind of like buying a car, driving it off the lot, and you see the value plummet. It's exactly what an option does. Or usually does. I shouldn't say always, because you just never know. But more often than not, options lose value. As long as, all else being equal, if the futures market isn't moving and things are quiet, they lose value very quickly. And again, like I mentioned before, they can even lose value if it goes in the direction of your trade. You can buy a call, watch the market rally, and your call can still lose value because it's losing more time value than it's making in directional value. We've all heard of the 80-20 rule. It seems to apply in just about everything we do. It's been said that the commodity markets spend approximately 80% of the time trading in a range and the other 20% of the time redefining that range. Again, there's no way to mathematically prove this, but I would say roughly it's probably true. Assuming that this is true, the same logic can be applied to long options simply because it takes a substantial price move in the futures market for a long option to be profitable. And we've talked about that through those examples. More options than not expire worthless, and that's really just the bottom line. It's not a coincidence that most literature and analysis suggests that the probability of an option expiring worthless is somewhere between 70 and 80%. I mean, think about it. If the market's trading in a range approximately 80% of the time, then the options are probably not paying off about 80% of the time. Another way to look at it is upon the purchase of an option, there's approximately 33% chance of the market going in the anticipated direction. I mean, this makes sense. The market can either go up, it can go down, or it can go sideways. Based on our simple assumptions, this leaves an option buyer with about a 66% chance of loss, even if the option is not held to expiration. What I'm trying to point out here is option trading can be a very, very valuable tool, but you have to know how to use them. Just buying calls and buying puts is not the best way to approach option trading. You want to be, if you're buying options, you want to be selling options around it and doing other types of things to help improve your odds of success, because strictly buying options does not have great odds of success. The most difficult thing about option trading is knowing that everything's on a time limit, at least for the buyer. As a seller, time is working on your side. If a day goes by with nothing happening, it was a good day. As an option buyer, if the day goes by and nothing happened, your options is slowly eroding to nothing. But the problem, or one of the most difficult parts about being a profitable option buyer, is that not only do you have to be right in the direction, but you have to be right in the direction within a specified time limit, and that's really, really tough to do. And we've kind of gone over this a little bit. There's a time and place for long options, low volatility, when option premium is really low, maybe it's worth putting out some lottery tickets. In extreme prices, when crude oil was at $150 a barrel, probably insane to sell the futures contract up there, but it probably would, well, now we know it would have been a great idea to just buy some cheap out-of-the-money puts and hope for the best, because you know what, they might have paid off really nicely. And in quiet markets, volatility is low and nobody's paying attention, you can find some cheap options and sometimes some attractive prospects for success. Because of the disadvantages faced by long option traders, I believe that an optimal approach might be to use both long and short options simultaneously to form a common goal. These are known as option spreads, and when we do part 2 of this class, we'll get into the specifics of an option strategy, putting it together, picking strike prices, picking all those types of things, adjusting and entering and placing your orders and all that kind of fun stuff. I'd like to thank everyone for attending. I'm sure we have lots of questions.
Yeah, we do. There's a lot. So first of all, I want to remind everybody that we're going to give away 5 of Carley's books. So don't go anywhere. We're going to do that at the end. And before we do that, and before we answer all these questions, Carley, I thought that maybe you could just give us like 2 examples, just using current prices again, to try to help everybody, myself included. So like right now, let's say that the S&P is trading at 1425, and I think it's going down. Okay. So we have a December expiration. So I think that before the end of the year, before expiration, I think it's going to go down. Now, that's all I think right now. I don't know anything else. What would I be looking at as far as? I guess you probably can't share your screen, or can you? Whenever I'm looking at the quote board, I'm going to see different bid asks, right, depending on the price, the strike price. Right. So now I'm going to show my how green I am with options, because I know basically nothing. Hopefully I know more after the webinar. Let's say that the further down price goes on the quote board, okay, so 1400, 1375, I am paying more or less in premium.
Okay. If the market right now is about 14, you know what, I am going to try to pull up my quote board here. I think it'd be easier. Just give me 1 second. I put it on a different computer because it uses a lot of juice.
And I'm bullish personally, right? But I'm talking about like as a hedge, like you're talking about. I'm trying to figure out how much am I really spending on this hedge? What would a hedge cost?
Right. Okay. That's a good question. Now, and obviously this isn't the best time of day to be looking at this stuff, because it's just probably the most illiquid time of the day. In fact, I think the mini is actually closed right now. I think we're in the, yeah, we are. But that's okay. We'll be able to see settlement prices. Okay, can you see this? Whoops.
Yeah, we can see it.
You can see it? Okay. All right, so this is the December E-mini S&P. All right, and I've got, yeah, there's no bid asks, but that's okay. We can go off settlement price. So the market's at 1425. Let's say that you want to buy a put as a hedge. All right, this is what kind of bread we're talking about here. There we go. All right, my platform is kind of neat in that it actually calculates it for us, so we don't have to worry about doing that. But, okay, market's at 1425. If you wanted superb, fabulous protection, you could buy a 1420 put. That's going to cost you about $18.75 or $37.50 in premium. Okay, the further out of the money you get, the cheaper it's going to be. So if you go to a 1410, it's $1,600. If you go to a 1400, it's $1,500. If you go to a 1380, it's approximately $1,100. So you get the idea. As you go further out of the market, or further out of the money, the options get cheaper, because the chances of it going to 1380 are a lot less than the chances of it going to 1390 or 1400. And you can just see how difficult it is for an outright option like this to actually pay off, because, okay, remember we said that we have to make up the premium. Well, if we're paying $23 for an option, before this, if we hold its expiration, this option doesn't do us any good unless we're trading below 1360, because we paid $23 to get in, so we have to make up that $20 before we start actually making money.
Right.
So it's a tough game. Now, you know, doesn't mean it's impossible, but it's a tough game, which is why we like to sell options.
Right, and I see somebody asked whether or not this is the mini or the big. This is the mini, right, that you're talking about. Now that's actually
it's the mini. Yep.
That's a good point, though. I mean, let's say that you want to do crude. Is there an equivalent of like QM, the mini crude? Is that, can you do options on mini crude?
Okay.
If it's too rich for your blood.
No, the mini crude does not have options, unfortunately.
Okay.
In fact, most of the mini contracts, like if you're talking about mini grains or mini metals,
right. Not going to happen.
The only mini that has options is the S&P. Everything else doesn't. Everything else you're trading full size.
Right. Gotcha. Okay. All right. So let me take a look at the questions here from the guys. Hang on.
Okay.
Okay. Gary wants to know, this might be an equity question. I don't know if you know the answer. With equities, there's a $25,000 pattern day trader rule if you want to be able to trade in and out over, I think, whatever. It's like a 3-day rule or something like that. You can only trade unless you have $25,000 in your account. You can't buy and sell the same day. You're flagged as a pattern day trader. Is there anything like that on the options side?
Wow, no, not on commodities. No, in all honesty, I've never even heard of that rule. But that gives me.
You're not an equities girl, so
no.
Yeah.
But it gives me a selling point because I am a futures broker, and that's great to know.
Yeah.
There's absolutely nothing like that in futures. You could have a $1,000 account and day trade, the eMicro gold or something. You can buy or sell 100 times a day with a $1,000 account. There's no restrictions at all.
And I wanted to back up a prior example. I hope you can hear me okay. My puppy is being mischievous in the background. You named an example where you said there was unlimited risk. Now, let's say that, let me see if I've got my terminology right. If I have sold a S&P call and the market's moving against me, it's going higher, then what are my options? Do I have to just sit on this, or can I just sell it, today instead of waiting until expiration and just get out with my loss? How does that work?
Right. No, you can get out at any time. The thing about options on futures, you could buy or sell them in the same day if you really wanted to. Like, we've had situations where we put out a recommendation to sell an option, one day, and by the next day or by that afternoon, it's already lost a ton of value, so we say buy it back. So you don't have to hold on to it to expiration by any means. Okay. What we tend to do, like, let's say, for example, we sell an S&P call and the market rallies against us. Let's say we were just dead wrong. We thought it was going down, it's going up, so we're on the wrong side of the trade. You can, number one, just buy it back and lick your wounds and be done with it at any time. You don't have to wait to expiration again. Or what we like to do is somehow adjust the trade. So like we might have been trading, let's say we were trading the October options and it went against us. We might buy the October back, take our loss, but we might still feel good about the trade. We just want to slow things down and get away from the heat a little bit. And so we might buy the Octobers back and sell Novembers at a higher strike price. So there's lots of things you could do. Or just like anything else, you can just adjust. Or sometimes if we're taking heat on one side of the trade, we'll say let's roll it into strangles. We don't really do that very often in the S&P, but some of the other markets we do. So like if we're short a crude oil call and the market just does not want to stop going up, we could buy it back and then sell a strangle instead. And the strangle would be like a neutral strategy. You're short a call and you're short a put. Market can go up, down, or sideways. You don't care as long as it doesn't go up or down too much. Right. So there's lots of things you could do. It's options are very versatile. You could make them do anything. Yeah. Okay.
Kathy has a question. So let's say that somebody here in the webinar wants to play around with options. Is it something like you as a broker, do you offer, or does somebody else offer a way for someone to create something like a trial account or a demo account and use that platform, QST or whatever, and see all these things and play around? What's needed for me to play?
Right. Well, we actually, if you go to carleytrading.com, we have several platforms that you can run demos on, and you could practice, basically paper trade. The only problem is most of them have a 30-day limit. With options, 30 days is, you can get a good feel of things in 30 days, but ideally we'd want a little more. But unfortunately, the exchanges actually charge for data, and so it's kind of crazy. Even like if you're in a demo account, even though you're you need it to learn and all these types of things, for whatever reason the exchange feels like they need to charge for that data. So it gets you can imagine it would get very expensive if demo accounts were unlimited. So unfortunately it just doesn't work that way. But yes, if you go to carleytrading.com, you can sign up for platform demos and you can practice, and we can walk you through things and give you a pretty good feel of how it would be option trading. At very minimum in 30 days you should be able to understand looking at an option chain, the quote board, entering orders, things like that.
Okay. Enrique asks, is 80-20 still valid with leaps? And remind everybody what leaps are.
Right. Leaps are basically super, like ultra long-term options. You know, I think some of them go out as far as 3 years or so. They're really long-term options. In all honesty, I don't have any experience trading leaps, so I don't want to say yes or no. I would guess that it probably does, just simply because options are priced to lose. You have to kind of keep in mind, like the way the markets price instruments, they're almost always, at least options, are almost always priced to lose. That's just how it is. So even though it seems like, you know, if you're buying a whatever Apple call option that has 4 years on it, it seems like you couldn't go wrong. The idea that you have to recoup all the premium that you paid to get in and all those other types of obstacles, I would say yes, it probably 80-20 rule probably still applies.
Okay, and I think that maybe this is, I'm trying to cut some of the questions down in the interest of time, but I think this one is worth maybe answering to give one more example. So Julia says, let's say that he's long 2 silver contracts and he wanted to use options as kind of like a stop. Is there something you could maybe briefly go over with us and explain how you would do something like that?
You could, yeah. Let me just pull up some silver here. The thing about silver is that's a real tricky one, though, because the silver options are
maybe you can just do the E-mini just to make it easier. I don't want to add too much complexity. Right. It's up to you.
No, that's right. The only problem with silver is the options aren't extremely liquid, and the problem is, and I would venture to say that it's partly the exchange is partly to blame, because you can see how many strike prices are listed here. I think if they only listed strike prices every 25 cents, I think they'd be better off. But anyways, that's besides the point. So like if you're long, let's say you're long 2 silver from, let's call it $34, okay? And the other reason maybe this isn't the best way to do it in silver is because silver options are very expensive. But if you're willing to, you know, if you want the protection and you're willing to do it, you could go long at 34, and then you could buy a put option at 34, and it's going to cost you, though. Let's assume that it's $1.20 times $50. It's like $6,000 for your insurance. So in a market like silver, I'm not sure that that's the best strategy, but you could do it. So if you were willing to pay $6,000 for your insurance and go along the future, then you don't have to use a stop. You make money, you know, as long as you recoup what you paid. Keep in mind, though, it's kind of the same idea as buying an option. If you go long at 34 and you pay $1.23 at expiration, you have to have recouped that $1.23. So the market's going to have to be up around, you know, $35. I don't know. One thing you could do, though, buy the future at 34, buy the put at 34, and then you could maybe sell a call or two up above. That way, at least you're financing your insurance, so it's not all your money. You're using the market's money to pay for your insurance. The downside of that is above whichever call you're selling, you're giving up any profit potential. So,
okay.
But it's just a way to cut down your expense.
Right, and I think we can cover a lot more of those types of scenarios in the next webinar, trying to keep this one as basic as we can. Okay, I apologize, guys. I am skipping some of the questions in the interest of time. Okay, so let's do this. Let's go ahead and give away the 5 books. Let's do that now, so let's get that going. And the way it's going to work, guys, is if you haven't done it before with us, we have 5 books to give away today. In the interest of fairness, the way we like to do it is the first person to answer the first question correctly will win that book. The second person to answer the second question correctly will win that book. And then, you know, by the time we get to the 5th question, it'll be the 5th person to answer correctly. And we do that because I've been told that, you know, some people aren't typing too fast, some people are in Australia and there's latency, you know, so we try to keep it nice and fair. Okay, so I'm going to turn things back to Carley for that. And if there's some time at the very end after the giveaway, we might try to squeeze in 1 or 2 more questions.
Okay, let's see if I can get this situated here. All right, so the first question is, as a buyer of a call option, what must happen in regard to the price and time for the trade to be profitable?
Okay, and Carly, after you see the correct answer in the screen scroll by, then just let me know. And this one will be easy because we're just looking
Okay.
for the first person. All right, guys, you can stop typing. I think we've probably got the answer by now. Is that right,
Yeah.
Carl?
I'm just trying. I'm just
Yeah,
trying to
because
sift through.
yeah, just I always tell everybody as soon as you see the right answer, just tell them to stop typing. That way, the screen will stop scrolling by.
Okay. It looks like to me. Some of them are pretty close, but I think well, hang on here. Okay, I'm going to say Pamela Anderson. There was a couple before
Okay.
that were really, really close, but I think hers is the most correct.
All right, so
And the
Pamela,
quickest.
what I need is your BMT username if you have that. And I just realized I forgot to tell everybody. So typically I ask everybody just to have a BMT username ready. That way I can private message you after we're done and I'll get your address and take care of all that stuff. So guys, I hope that everybody here is a BMT member. If you're not a BMT member, then just give me your email address, okay? So Pamela, okay. Great. Second question.
Okay.
I'm sorry, did you repeat the answer so everybody knows what the answer was?
I didn't. The price must exceed the strike price plus the premium before the time is expired. Yes, I mean that's pretty accurate. Based on at expiration. That's exactly true. But before, yes, that's also true. There's a few others that were very, very, very close, but they mentioned the word close, and it doesn't really necessarily matter what the close was. It's just the price outright. So hopefully the others will get it on the next one. All right, let's go. The second question. If a purchased put is in the money, what does that mean?
And can you go full screen on the PowerPoint?
Okay, I think Rob Hunt has that one. Yeah, we've got an answer.
Okay, everybody stop typing, please. And I got to find it on my list. Was Rob the second person? We're going to hopefully that we have enough people answering right to try to make it to where the second. I don't know if those questions are too hard, that may not work. We'll see.
He was right off the bat. He was one of the first. Yes.
Okay, Rob, give me your BMT username, please. Okay, okay, great. And what was the right answer, Carly?
If an option's in the money, then it has intrinsic value, meaning that in the case of a put, the futures price is below the strike price of the put option.
Okay, and I see somebody asking what's a BMT username. BMT is my site, Big Mike Trading. So if you came here from Carly and you don't have a username on the forum and you end up winning a book, then just give me your email address instead. Otherwise, I'd like to get your username. It's easier for me. Okay, so question 3. So we're going to try to make it the third person that answers correctly. Let's see if we have enough correct answers to do that.
Okay. If you're bullish a market, what 2 types of outright option strategies could you execute in attempt to capitalize? Okay, we've got the answer.
All right, guys. So stop typing, please.
And Bill.
Okay.
Bill Street.
Okay, Bill. I need your BMT username and. Do you have one? Type that in. All right, so what was the right answer, Carly?
Buy a call or sell a put.
All right, next question.
Okay, are we ready for the next one?
Yeah, I'm sorry, go ahead.
Okay, no problem. Okay, define option premium. Okay, we've got it already. Andy H.
Okay, Andy, I need your BMT username, please. And Carly, so what was the right answer?
It's the price of the option. It's just the price. Premium and price are the same thing.
Okay, and then here's the fifth and final question.
Okay. Which outright option strategy offers traders limited profit potential and unlimited risk, but favorable odds of success? Okay, we've got it. We're done. We can stop typing.
All right, yeah.
Okay, Michael Fearon.
All right, Michael, I need your BMT username, please. Can you type that in? Okay. All right, guys. So, Carly, maybe you can throw up a contact slide, and then we can try to squeeze in maybe 2 or 3 more questions. If anybody has any really, really good questions that they'd like to get answered right now, go ahead and type those in. We'll see if we can get them done. I'm sorry, what was the answer to that? I'm trying to make sure we repeat the answer.
Sell options, short options,
okay.
Sell them.
Okay, guys, so let's see if we can get a couple more questions answered. And also, you can always email Carly. There's her email address, and check her out on her website if you have any other questions that you'd like to get answered. Rick wants to know, so you're still an introducing broker. I guess, you were involved, unfortunately, with the whole PFG mess.
Right.
So how are things working out for you now?
Well, things are as good as they can be. I mean, it was definitely a challenge that I wish my clients and myself didn't have to go through, but we can't change it. All we can do is move forward. Yep. We are still operating as an independent, as an IB. We are actually a branch of Zaner Group now, and they're an independent IB. So instead of being tied to one brokerage firm like we were before with PFG Best, we actually are working with about 7 or 8 brokerage firms. So in the long run, it'll actually end up being good for us and our clients. It's just in the short term, it's going to be a challenge.
Right. Okay, if anybody else has questions, let me know. Bruce is asking a question that I don't really understand. Is the Google Vringo situation an ideal opportunity? Do you have any idea what he's talking about?
To be honest, I don't.
Okay, well, at least I'm not alone.
Right.
All right, guys. I think actually we should just stop the questions. We're already pretty long on the webinar, so I encourage everybody to just send Carly an email and let her know if you have other questions, and then I'll try to put together some feedback also, so we'll have a good idea of what we should cover in the next webinar, which we're going to make more advanced. And I want to remind everybody that I will be posting the recording for this webinar sometime tomorrow. I'll send it over to Carly so she can send it to all you guys as well that follow her. All right, guys, thank you very much, Carly. I really appreciate your time, and I'm looking forward to watching this one again so I can go back and make some more notes, and definitely the next one as well.
All right, sounds good. I appreciate it. Thanks, Mike.
Thanks, guys. See everybody on the forum. Bye.